The charts are screaming a warning. The tokenomics engine, the very heart of Shiba Inu's deflationary dream, just suffered a catastrophic failure. A sudden, brutal collapse in the burn rate has sent shockwaves through the community, raising critical questions about the long-term viability of the project. Analysts are dropping their alerts, whales are moving silently. But what am I even talking about? Well, let me explain. Welcome to Dr. Crypto, your daily serving of Shiba. This is the spot for you if you're curious about anything related to Shiba. If you want to keep informed about all the latest news forecasts and stay ahead of the crypto industry, subscribe. To get more Shib news, be sure to click the like button. Please note that by the time you see this video, some rates may have changed. Financial advice is not included in this video. To understand the gravity of the current situation, we must first establish the fundamental role of the burn mechanism within the Shiba Inu ecosystem. The project's tokenomics are designed around the principle of deflation, reducing the circulating supply of the token over time to increase scarcity and, theoretically, boost the price. This process is primarily facilitated by the Layer 2 solution, Shibarium, which is supposed to allocate a portion of its transaction fees to permanently remove Shiba Inu tokens from circulation. The community has been conditioned to view the burn rate as a key performance indicator, a direct measure of the ecosystem's health and activity. When the burn rate is high, it signals robust usage of Shibarium and a strong commitment to the deflationary model. Conversely, a sharp decline suggests a critical slowdown in network activity or a fundamental flaw in the burning process itself. The current event is not just a minor dip. It is a profound statistical anomaly that directly challenges the core narrative of Shiba Inu's supply reduction strategy. This is why the recent data has triggered such intense scrutiny from market observers and developers alike. The main news is stark and undeniable. The Shiba Inu burn rate has collapsed by a staggering 88% in the last 24 hours. Community trackers show that the amount of Shiba Inu tokens removed from circulation plummeted from over 34 million tokens on the previous day to a mere 4.1 million tokens. This event is particularly ill-timed, as it occurs just ahead of a crucial period for the wider crypto market and the Shiba Inu ecosystem. The market is bracing for a decisive week, with the Federal Reserve's final policy decision of the year anticipated. More directly relevant to Shiba Inu, a major exchange is set to launch U.S. perpetual-style futures for the token, a development that is expected to significantly increase institutional exposure and trading volume. The burn collapse casts a shadow over these bullish developments, forcing the community to confront the reality of the Urgunt tokenomics engine's current performance at a moment when maximum confidence is required. The market's initial reaction to the burn rate collapse has been one of cautious consolidation rather than panic, suggesting that the news has been partially offset by broader market optimism and the anticipation of the future's launch. As of today, Shiba Inu is trading at approximately 848 units. This price point is holding a critical support level, but the lack of a strong upward momentum is palpable. The 24-hour trading volume stands at approximately $101 million, a figure that, while substantial, is considered modest for a token of this size and is indicative of a market awaiting a clear directional signal. The overall market capitalization remains robust at approximately $5 billion, cementing its position among the top-tier digital assets. However, analysts note that the price action is not reflecting the severity of the burn collapse. The market appears to be in a holding pattern, with traders prioritizing the macroeconomic factors, such as the expected Federal Reserve rate cut and the upcoming institutional adoption. This temporary resilience is a double-edged sword. If the burn rate does not recover quickly, the market may eventually price in the tokenomics failure, leading to a delayed but potentially more severe correction. The current price stability is therefore viewed by some as the calm before a potential storm, where the fundamental weakness of the deflationary mechanism is being ignored for the sake of short-term speculative interest. A deeper dive into the on-chain data for Shibarium reveals the underlying cause of the burn rate failure, a significant slowdown in the network utilization. The burn mechanism is directly tied to the volume of transactions on the Layer 2 network, and the data shows a clear deceleration in user activity. According to market data, the daily transaction count on Shibarium has recently dipped to a concerning low of just 2,420 transactions, This is a dramatic drop from the network's peak activity earlier in the year, when daily transactions were consistently in the millions. While the total number of transactions processed by Shibarium remains impressive at over 168 million, and the total number of unique wallet addresses stands at over 5.15 million, these cumulative figures mask the current critical lack of daily engagement. The total value locked on Shibarium also tells a story of stagnation. The TVL, which represents the total value of assets currently staked or locked in the network's decentralized finance protocols, is a modest $2 million. For a project with a multi-billion-dollar market capitalization, this low TVL suggests that Shibarium has failed to attract significant capital or establish itself as a dominant player in the Layer 2 decentralized finance space. This low level of utility means that the primary engine for generating burn fees is sputtering, directly leading to the 88% collapse in the burn rate. The technical evidence confirms that the problem is not a temporary glitch, but a systemic issue of low adoption and utility. The implications of the 88% burn collapse are profound, forcing a reevaluation of Shiba Inu's long-term investment thesis. Analysts are now openly questioning the project's over-reliance on the burn mechanism as a primary price driver. Expert commentary suggests that the tokenomics engine is indeed failing in its current form because the rate of burning is simply not keeping pace with the quadrillion coin supply. Even with aggressive burns, the total supply reduction remains statistically insignificant in the short to medium term. The recent collapse highlights the volatility of the burn rate, which is entirely dependent on the fluctuating and currently low level of activity on Shibarium. The lead developer has previously acknowledged this limitation, stating clearly that burns alone will not be enough to propel Shiba Inu's price to new heights. The focus, according to the development team, must shift to utility and adoption. However, the current on-chain data suggests that this shift has not yet materialized in a meaningful way. The low total value locked and daily transaction count imply that the utility-driven narrative is struggling to gain traction. The most significant implication is the potential for a crisis of confidence. If the community loses faith in the deflationary model, the speculative interest that has historically driven Shiba Inu's price could evaporate. The burn collapse serves as a harsh reminder that without sustained high-volume utility, the tokenomics model is fundamentally flawed and unsustainable. The community reaction to the burn collapse has been a mix of concern, denial, and a renewed call for developer intervention. On social media platforms and forums, the news has been met with a wave of fear, uncertainty, and doubt, with many retail investors expressing anxiety over the project's direction. However, the core Shiba Inu community, often referred to as the Shib Army, has attempted to frame the event as a temporary fluctuation, pointing to the slightly positive weekly burn rate as evidence of resilience. They are also heavily focused on the upcoming futures launch, viewing it as the true catalyst that will overshadow any tokenomics concerns. Developer reactions, while not directly addressing the 88% collapse, have focused on the long-term roadmap and utility upgrades. The team is reportedly working on a major Layer 2 privacy upgrade, in partnership with a cryptography firm, which is slated for the second quarter of 2026. This focus on future utility, such as AI gaming deals and privacy enhancements, is an attempt to shift the narrative away from the current burn rate woes and towards a more sustainable, utility-driven future. The developers are essentially telling the community to look past the immediate data and focus on the foundational technology being built, but this requires a significant leap of faith from investors who are currently seeing a critical metric fail. The immediate forecast for Shiba Inu is dominated by two major conflicting forces: the tokenomics failure and the institutional adoption push. In the immediate future, the price action will be almost entirely dictated by the macroeconomic environment and the futures launch. If the Federal Reserve delivers the expected rate cut, a general crypto market rally could temporarily lift Shiba Inu, pushing it towards the 900 unit range. The launch of U.S. perpetual-style futures is a major bullish event that could introduce significant new capital and trading volume, potentially overriding the negative sentiment from the burn collapse. However, if the burn rate does not show a clear recovery within this time frame, the tokenomics narrative will continue to be a drag, capping any major price surge. The long-term forecast is entirely dependent on the success of the Layer 2 utility. For Shiba Inu to achieve a significant price increase, such as a 10x surge, it would require the burning of hundreds of trillions of tokens. This is only possible if the Layer 2 solution achieves massive, sustained adoption. The planned 20s privacy upgrade and the focus on AI gaming are positive steps, but they must translate into millions of daily transactions and a total value locked in the hundreds of millions of dollars. If the developers successfully pivot to a utility-first model, the long-term outlook is positive. If the network remains stuck with a low total value locked and low daily transactions, the tokenomics engine will continue to fail, and the price will likely consolidate or decline over the long term. A balanced assessment of the current situation must acknowledge the significant risks inherent in Shiba Inu's current market structure. The 88% burn collapse is a clear red flag that cannot be ignored. It exposes the fragility of a deflationary model that is overly dependent on a Layer 2 solution that has not yet achieved critical mass adoption. The primary risk is the tokenomics trap. The community's obsession with the burn rate creates a self-fulfilling prophecy of disappointment. When the burn rate fails, as it has now, it fuels negative sentiment, which in turn discourages new users and developers from engaging with the Layer 2 solution, further reducing the burn rate. This vicious cycle is the core challenge facing the project. Furthermore, the market is becoming increasingly saturated, with new utility-focused meme coins that are attracting capital away from older projects. The overdependency on the burn narrative, coupled with the low total value locked, makes Shiba Inu vulnerable to competition. The cautionary point is simple. Investors must view Shiba Inu not as a deflationary asset, but as a speculative asset whose price is driven by hype and community sentiment, with the added potential of future utility. The burn rate is a metric of utility, and its failure is a warning that the utility is not yet there. The upcoming futures launch provides a short-term lifeline, but the fundamental tokenomics issue must be resolved for long-term sustainability. The burn collapse is a harsh reality check, exposing the cracks in the foundation of Shiba Inu's deflationary dream. The market is holding its breath, waiting for the future's catalyst, but the tokenomics engine is sputtering. The question is no longer if the developers will act, but how they will fix a system that is currently failing to deliver on its core promise. This is a pivotal moment. The next few weeks will determine if Shiba Inu can pivot to utility, or if the burn collapse signals the beginning of a long, slow decline. The day is over now. Remember to give it a big thumbs up. To see our most recent material, share it and subscribe to the channel.